Something is breaking, quietly, structurally. For decades, silver was treated as secondary, industrial, manageable, but the numbers no longer reconcile. A ratio that guided capital for centuries is destabilizing. Supply that was assumed to exist no longer does. Those relying on old models will not recognize the shift until it becomes irreversible. This is not about price targets. It is about exposure and timing. Because when this adjustment becomes obvious, the window to respond may already be closed. Welcome to Hidden Currency. This channel exists for people who have lived through cycles. People who understand that wealth is preserved quietly long before it is discussed publicly. If they are over 50, if they spent a lifetime building what they have, this channel was created with them in mind. Subscribing is not about excitement. It is about staying informed before conditions force decisions. And before continuing, they are invited to leave a comment below. Where are they watching from today? Texas? California? Florida? Or somewhere else in the world? Location matters more than most realize. For most of modern financial history, the gold to silver ratio served as a silent indicator of balance. It did not exist to predict prices. It existed to signal stability. When the ratio remained within historical ranges, trade flowed smoothly and confidence held. When it moved sharply, stress usually followed elsewhere in the system. Over time, many decision makers concluded this signal no longer mattered. Gold became classified as a reserve asset. Silver was reduced to an industrial input. As the ratio widened year after year, markets appeared calm. Analysts assumed silver had permanently lost its monetary relevance. That assumption is now proving risky. In recent years, the ratio reached levels never sustained before. It climbed beyond 120 ounces of silver to 1 ounce of gold. Historically, such extremes appeared only during short moments of crisis. This time, the distortion lasted for years. Stability was assumed, but the signal was stretched far beyond normal limits. The reason this imbalance persisted was not natural supply and demand, it was structure. Silver pricing became dominated by financial instruments rather than physical exchange. Paper contracts expanded exposure without requiring delivery. Large volumes of silver existed in accounting systems without metal moving anywhere. As long as trust remained intact, the system functioned. But ratios do not change meaningfully without cause. When the gold to silver ratio finally began to fall, it did not drift slowly. It broke through levels that had held for decades. This was not a short-term fluctuation. It was a structural shift. Ratios behave differently than prices. Prices move with emotion. Ratios move when relative value changes. When a long-stretched ratio begins to compress, it signals repricing. Either confidence in one asset is weakening, or the other is being reassessed upward. In this case, evidence points toward reassessment. Silver was not undervalued because demand disappeared. It was undervalued because price discovery was delayed. Paper markets masked physical tightening. Industrial use increased quietly. Inventory buffers thinned slowly. Recycling could not compensate. Yet prices stayed calm because the system did not require immediate delivery. That delay is now ending. Long-term charts showed a reversal pattern forming over many years. When it completed, the ratio crossed critical thresholds. Patterns of this size do not resolve gently. They suggest magnitude rather than timing. This phase is often described as contagion. Once a structural level breaks, capital that previously ignored the signal begins to respond. Models adjust, algorithms recalibrate, exposure changes without formal announcements. The danger lies in delayed recognition. Most business leaders rely on summaries and reports. By the time official commentary acknowledges a shift, capital is already repositioned. And this is not about predicting exact prices. It is about recognizing correction after distortion. Markets suppressed for long periods tend to overshoot when they adjust. They move beyond balance before stabilizing. For serious decision makers, the lesson is awareness, not urgency. Systems signal stress before they fail. Ratios are one such signal. Ignoring them does not prevent outcomes. It only limits preparation. The ratio itself is not the story. It is the warning light. Most people believe silver is abundant. They assume it exists in vaults, warehouses, and reserves, waiting to meet demand. This belief feels reasonable because prices remained calm for years. But price stability does not always reflect supply reality. In the case of silver, it reflected assumptions, many of them incorrect. The first misunderstanding begins with how silver is produced. Unlike gold, silver is rarely mined on its own. The majority of global silver supply comes as a byproduct of mining other metals, such as copper, lead, and zinc. This detail changes everything. It means silver production does not respond directly to silver prices. When demand rises, miners cannot simply increase output. They mine based on the economics of other metals. If copper demand slows, silver supply falls with it, even if silver demand is rising. This creates a rigid supply structure. Economists call it inelastic. In practical terms, it means the market cannot quickly respond to shortages. New mines take years to permit, finance, and build. Recycling helps, but it cannot scale fast enough to close large gaps. Above all, there is no switch that can be flipped to produce more silver when it is urgently needed. Yet financial markets behaved as if such a switch existed. For decades, silver prices were shaped more by paper instruments than by physical flows. Futures contracts, options, and unallocated accounts expanded supply on paper without requiring metal to be delivered. These instruments served a purpose. They provided liquidity and price discovery. But over time, they also created an illusion. The illusion was that silver was plentiful. And when an investor bought paper silver, the system recorded demand without moving metal. When a trader sold short, the system added supply without extracting ore. As long as participants trusted settlement mechanisms, this structure held. Price signals remained calm even as physical availability tightened. The problem arises when trust and reality begin to diverge. Physical silver must be mined, refined, transported, and stored. Each step has constraints. Energy costs rise, environmental rules tighten, ore grades decline. These pressures do not show up immediately in paper markets. They accumulate quietly, year after year, until buffers disappear. Those buffers are now thinner than most models assume. A common belief is that large amounts of silver sit above ground, ready to be mobilized. In theory, this is true. In practice, much of that silver is not available. It is embedded in products, held in long-term storage, or located in jurisdictions where export is restricted. Some inventory exists only as accounting entries tied to multiple claims. Availability is not the same as existence. This distinction matters because industrial users do not buy claims. They require delivery. When manufacturers plan production, they cannot accept cash settlement instead of metal. If silver is not available at the right time and place, production slows or stops. At that point, price becomes secondary. This is where the supply narrative changes. As industrial demand grows, priority shifts away from financial markets. Physical buyers are willing to pay premiums for certainty. They care less about spot prices and more about continuity. When this behavior spreads, paper prices lose authority. They no longer represent the marginal unit of supply. Financial systems are slow to adjust to this shift. Risk models still assume liquidity. Balance sheets still treat silver exposure as interchangeable. But the moment physical stress becomes visible, assumptions are forced to update. That update often happens abruptly. History shows this pattern repeatedly. Commodities remain undervalued until supply constraints become undeniable. Then prices move faster than expected, not because demand explodes overnight, but because pricing mechanisms change. In silver's case, the shift is compounded by its byproduct nature. Even if prices rise sharply, production cannot respond in time. This lag creates a feedback loop. Higher prices signal scarcity. Scarcity increases precautionary buying. Precautionary buying tightens supply further. At that stage, the question is no longer whether silver is scarce, but who gets access. For business leaders, this introduces a strategic concern. Supply chains built on just-in-time delivery assume stable inputs. When an input becomes uncertain, it affects planning, contracts, and capital allocation. Exposure to silver is no longer limited to investors. It extends to manufacturers, technology firms, and infrastructure projects. The mistake many make is focusing only on price charts. Price is the last signal. Supply stress shows up first in delivery times, premiums, and contract terms. By the time prices respond, positioning options narrow. This is why the current moment matters. The silver market is not signaling panic. It is signaling transition. Paper assumptions are being tested against physical limits. When such tests fail, markets do not adjust smoothly. They reprice. And once supply reality asserts itself, the debate shifts from how much does it cost to who can get it at all. For years, silver demand was discussed as if it were optional. Analysts spoke about jewelry cycles, investor interest, and temporary industrial trends. This framing created a dangerous misunderstanding. Silver demand today is not discretionary. It is structural. What is changing is not how much silver is used, but who needs it most. Silver is no longer a background material. It has become a critical input in systems that governments and corporations consider non-negotiable. Energy infrastructure, electrification, advanced electronics, medical technology, and next-generation batteries all rely on silver's physical properties. These uses cannot be substituted easily. In many cases, they cannot be substituted at all. Silver conducts electricity better than any other metal. That single fact makes it irreplaceable in high-performance applications. Engineers can reduce usage per unit, but they cannot eliminate it. Efficiency gains slow demand growth, but they do not reverse it. As total production scales up, total silver demand still rises. This creates a structural floor under demand. The most important shift is priority. Industrial buyers do not respond to price the way investors do. If silver prices rise, investors may pause or sell. Industrial users cannot. If they stop buying silver, production lines stop. Contracts are missed, systems fail. In this context, silver is not a commodity. It is an operational necessity. This difference changes market behavior. When industrial demand becomes dominant, markets stop clearing through price alone. They clear through allocation. Long-term contracts replace spot purchases. Strategic stockpiles replace just-in-time delivery. Buyers move earlier in the supply chain to secure access. These actions reduce available supply for everyone else. At the same time, new sources of demand are emerging faster than supply can adapt. Energy transition policies are not theoretical. They are being implemented through mandates, subsidies, and infrastructure spending. Solar capacity continues to expand globally. Electric systems require more redundancy, more storage, and more transmission. Each layer adds incremental silver demand. None of it is optional once projects are approved. Battery technology adds another layer of pressure. Advanced batteries require higher purity materials and tighter tolerances. Silver's role in these systems is small per unit, but large in aggregate. When production scales from thousands to millions of units, marginal demand becomes material demand. This is where models fail. Most demand forecasts assume linear growth. They extrapolate from past usage and apply efficiency assumptions. But structural demand does not behave linearly. It accelerates when systems reach adoption thresholds. Once infrastructure commitments are made, demand becomes locked in. At that point, price elasticity disappears. Governments and corporations also behave differently under strategic pressure. When materials become critical, market access can be restricted. Export controls, domestic stockpiling, and preferential allocation become politically acceptable. History shows that in such environments, private buyers move last. This creates a silent conflict. On one side are investors who view silver as a financial asset. On the other are institutions that view silver as infrastructure. When supply tightens, infrastructure wins. Financial exposure can be settled in cash. Infrastructure cannot. The result is not a sudden shortage headline. It is gradual exclusion. Retail buyers face higher premiums. Delivery times extend. Contract terms change quietly. These signals often appear before prices move significantly. Those who wait for confirmation from price charts usually arrive after access is narrowed. Another important factor is visibility. Industrial demand does not announce itself daily. Contracts are private. Supply agreements are negotiated quietly. By the time aggregated data reflects increased usage, the metal has already been allocated. This delay creates false confidence. Market participants look at current prices and assume demand is manageable. They do not see the commitments already made for future delivery. They do not see the stockpiles being built. They do not see the inventory being removed from circulation. By the time these dynamics become visible, the adjustment is already underway. For entrepreneurs and business leaders, this matters beyond investment. Silver exposure exists indirectly through supply chains. Rising input uncertainty affects margins, timelines, and risk management. Ignoring this because silver seems like a small component is a common mistake. Small components can halt large systems. Demand acceleration does not announce itself loudly. It reveals itself through competition for priority. And when priority shifts, markets stop asking who wants to buy. They start deciding who must be supplied first. When markets adjust to new realities, they do not move evenly. They reprice in stages. The first stage is denial. The second is adjustment. The third is acceleration. Most participants recognize change only in the third stage, when options are already limited. Silver is now entering that sequence. For a long time, capital treated silver as a secondary asset. It was grouped with commodities rather than strategic materials. Portfolio allocations remained small. Risk models assumed liquidity. This allowed large institutions to ignore silver without consequence. But once structural signals begin to align, supply stress, demand priority, and ratio breakdown, capital behavior changes. Repricing does not begin with headlines. It begins with positioning. Early movers do not act because they expect a specific price. They act because they recognize asymmetry. The downside is limited by physical necessity. The upside is driven by structural shortage. This imbalance attracts capital quietly at first. Long-term holders replace short-term traders. Inventory is removed from circulation, not for speculation, but for security. This is where delay becomes costly. Most investors wait for confirmation. They look for official validation, analyst upgrades, or visible price strength. By the time these appear, repricing is already underway. The market no longer offers calm entry points. Volatility increases, spreads widen, access becomes uneven. Late-stage participants often misread this phase. They interpret rising prices as risk, not as evidence of earlier mispricing. They hesitate, waiting for pullbacks that may never arrive. When they finally act, they do so emotionally, not strategically. This behavior is predictable. Markets are not moved by the average participant. They are moved by the marginal decision. When marginal buyers shift from speculative to strategic, price behavior changes. Corrections become shallow. Sell-offs are absorbed quickly. Volatility compresses upward. At this point, traditional valuation tools lose relevance. Ratios that once seemed extreme begin to normalize under new assumptions. Price targets that once felt aggressive become conservative. This is not because fundamentals changed overnight, but because recognition finally caught up with reality. Another critical factor is exit behavior. In repricing phases, many participants sell too early. They define success using old benchmarks. A price that once seemed high becomes a psychological ceiling. They take profits to reduce regret, not to optimize outcome. This transfers exposure from impatient holders to patient ones. Those who exit early often watch from the sidelines as prices continue higher. Re-entry becomes difficult, both financially and psychologically. This reinforces the cycle, pushing capital further into the hands of long-term holders. From a strategic perspective, the greatest risk is not volatility, it is misalignment. Business leaders and investors often separate operational risk from financial risk. In the case of silver, that separation is artificial. Supply stress affects production. Production affects earnings. Earnings affect valuation. What begins as a materials issue becomes a balance sheet issue. Those who recognize this connection early adjust quietly. They hedge exposure, they secure supply, they diversify inputs, they do not wait for disruption to force action. Those who delay face narrowing choices. Another overlooked aspect of repricing is jurisdiction. As materials become strategic, national interests assert influence, policies change, access becomes political, markets fragment. What was once a global pool becomes regional, prices diverge, availability becomes uneven. In such environments, financial instruments offer less protection. Physical access, contractual certainty, and jurisdictional awareness matter more than theoretical exposure. This shift disadvantages those whose strategies rely solely on paper markets. The final stage of repricing is normalization. After volatility, markets stabilize at new levels. Narratives adjust, analysts rewrite models. What once seemed unthinkable becomes accepted. At that point, opportunity is replaced by consensus. Returns diminish. Risk appears lower, but so does upside. The purpose of recognizing repricing early is not to predict extremes. It is to avoid being forced into reactive decisions. Silver's current position reflects years of delayed adjustment. Structural signals have aligned. Capital is beginning to respond. The process will not be smooth, but it will be directional. For decision makers, the question is not whether repricing will occur. It is whether their exposure is intentional or accidental. Strategic delay feels safe because it avoids immediate action. But in environments shaped by physical limits and priority demand, delay carries hidden cost. By the time clarity arrives, flexibility is gone. Markets do not reward certainty. They reward preparation.